Options trading might come across as a challenging puzzle, but don't worry. Today, we're launching our comprehensive and thorough beginner's guide to options trading. We'll navigate the seas of options trading and guide you through the waves of knowledge. Trust me, by the time we're done here, you'll have a much clearer understanding of how this intricate art works. So, let's get right into it. First up, let's talk about the concept that sets options apart: expiration dates. Unlike stocks that have an indefinite lifespan, all option contracts come with an expiration date. Once this date, known as the expiration date, rolls by, the option contract loses its mojo. It vanishes into thin air, leaving no traces. Now, here's where it gets interesting. Because options expire, you've got to pick your trading timeline. Do you fancy options that expire today, or do you want to go big with options that wave goodbye years from now? These extended contracts are called LEAPs, which stands for Long-Term Equity Anticipation Securities. Fancy name, huh? Next on the list is the strike price. Every options contract, in addition to an expiration date, flaunts a strike price. Think of this as the magical number at which an option transforms into stock. Picture this: you hold a call option with a strike price of $105. This means you can turn that option into actual stock at a delightful $105 per share. Imagine you're trading a stock that's strutting around $120 per share. Would you prefer it at $120 or snagging it at the sweet deal of $105? See the power? But wait, there's more! Every options contract also wields an options contract multiplier, a figure that holds the key to some fascinating insights. Picture this. Typically, this multiplier stands at a solid 100 shares. Now, what does this mean for you? Well, it boils down to the fact that owning a single options contract gives you the power to either buy for a call or sell for a put, a whopping 100 shares of stock. But there's more. It's all bound by a specific strike price and a set date. Why did they pick 100 shares? Well, it's all about making options trading standardized. Imagine if every options contract represented a different quantity of underlying stock. Chaos, right? So that's where the 100 share rule steps in, streamlining the trading process and avoiding a potential nightmare scenario. But here's the twist. This multiplies feature adds a layer of complexity to options pricing. To get the true value of an option, you need to multiply its coded price by, yep, you guessed it, 100. Now that we understand the core characteristics of options trading, let's build on our knowledge and discuss the two different option types, calls and puts. Before we get into the nitty-gritty of call options, remember, options are what we call derivatives. This means their value is linked to something else, in this case, the value of a stock. So, owning a call option isn't just about owning any option, it's about owning a call option tied to an underlying stock or index. So, what exactly is a call option? A call option, or simply a call, is like a financial magic wand. It lets an investor buy 100 shares of a stock at a predetermined price. We call this price the strike price, either on or before the option's expiration date. First things first, when the stock price goes up, the price of a call option usually follows suit. It's like a positive buddy system for your investment. Conversely, when the stock price dips, the call option's price tends to drop as well. It's like when your favorite ice cream shop has a sale and everyone rushes in for those sweet deals. Imagine you're in the market for a home, a cozy little house you believe will increase in value over time, just like an investment, right? Now you've got your eyes on this dreamy home with a price tag of $200,000. You know it's a fantastic deal, but here's the catch. You don't have the full amount up front. Bummer, right? But don't fret, we're about to introduce you to the power of options. In the real world, if you don't have the cash to buy that house now, tough luck, you can't hold it for a future purchase. But what if the housing market worked like the options market? Buckle up, because we're about to turn imagination into reality. Just like in options, we have some critical terms: the strike price, which is $200,000 in our case, and an expiration date, which is 2 years from now. Got it? Perfect. Let's say we're creating an options contract for this house. So, what trade details do we need to consider? Well, we've got the strike price locked at $200,000 and our contract's expiration date is set 2 years from today. Just like that, we've got the foundation of our options contract. This contract grants us a super cool right, the right to buy that charming house for $200,000 within 2 years from today. Yep, you heard it right. But here's the kicker. What if the shoe was on the other foot? What if we were the seller of that house? Would we be dancing in agreement? Well, let's dive in. Imagine you're the proud owner of that gorgeous house. Someone approaches you saying, "Hey, I want the option to buy your house for $200,000 in 2 years." How would you react? Exactly. You'd probably give them a puzzled look. See, if the house's value falls, you, the buyer, can simply walk away. It's like buying a ticket to a concert and deciding not to go if the artist isn't performing your favorite song. But wait, there's a twist. What if we offered to pay the seller for this right? Suddenly, their interest is piqued. Imagine we walk up to the seller, put some money on the table, and say, "Hey, let's have the option to buy your house for $200,000 in 2 years. Now, it's not just about rights, it's about compensation. So the million-dollar question: how much should we pay the seller for this valuable right? Drumroll, please. Calculating the price is where things get intriguing. The seller wants to be compensated for the risk they're taking by granting us this option. It's like the cost of insurance against future price drops. Factors like the current house value, the time until the option expires, and market volatility all come into play. This magical number we pay the seller is known as the option premium. For the privilege of having the option to purchase the house at $200,000 within 2 years, you pay the seller $10,000 upfront. It's like a reservation fee for your financial adventure. Fast forward a bit. A year has passed and the house's value has skyrocketed to $350,000. Incredible, right? Now here's where it gets interesting. Remember that call option you bought at the $200,000 strike price for $10,000? That means for this trade to be a break-even, the value needs to surpass not only the strike price, but also the premium. So, your break-even point is $210,000. But guess what? With the house's current value at $350,000, things are looking mighty fine for you. Time to do the math. $350,000 minus the break-even point of $210,000 equals a whopping $140,000 in profit. Now, here comes the reality check. What if in 2 years, the housing market takes an unexpected dive? What if that once prized house is now valued lower than your strike price? In that case, things aren't as sunny. You might decide not to exercise the option and walk away. While you would lose a $10,000 premium, you wouldn't be forced to buy a house above its current market value. Now, let's explore what put option really is. A put option, or simply put, is like a magical financial tool that gives you the right to sell a stock at a predetermined price by a specific date to the seller of the put. Picture this. When stock prices fall, put options rise in value. It's like the evil twin of a call option. But let's keep it simple with some bullet points. Put options increase in value as stock prices drop. They allow you to sell 100 shares of stock at a specific price by a certain date. Unlike call options, where you had the right to buy shares, put options give you the right to sell shares. Since put options give you the right to sell a stock, it's logical that their value increases when stock prices drop. Think of it like this. As the value of your house decreases, suddenly that insurance policy you bought against its decline becomes much more valuable. When the market takes a dip, put options can swoop in to save the day and potentially bring in some sweet profits. Next on our options education journey comes the price components. An options price is like a puzzle with two crucial pieces: intrinsic value and extrinsic value, also known as time value or theta. Think of them as a dynamic duo shaping an option's worth. Imagine this: you're at the heart of option pricing, and you're gazing at two essential elements. First up, we have intrinsic value, the profit potential an option holds based on its strike price compared to the stock's market price. Then there's extrinsic value, also called time value or theta. This portion of the premium is linked to the time left until the option contract expires. It's like the ticking clock driving the option's value. Now that we've established the groundwork for understanding option prices, let's take a step back. Remember those long call and long put trades we discussed earlier? They're the foundation of your options journey. Mastering these basics is non-negotiable because, believe it or not, they're the building blocks of countless complex strategies. Without a firm grasp on calls and puts, you're like a musician without her instrument. It's when you combine these that things truly start to get interesting. To calculate intrinsic value, let's revisit that house scenario. Imagine that this house's intrinsic value is the value it holds independently without any external influences. Intrinsic value is like a special quality possessed by things valuable on their own. Think of it as a kind of inner worth. Keeping the valuable on its own idea in mind, our intrinsic value here would be the house's value minus the strike price, $350,000 minus $200,000, which equals $150,000. This is the option's self-contained value, irrespective of external factors. Wrap your head around this. Intrinsic value equals being in the money. It's like having a backstage pass to an amazing concert. It's special on its own. But hold on, we're not stopping here. Let's talk about the intrinsic value of put options. Ready for a twist? If calls were your jam, now it's time to embrace the world of puts. For puts, just flip everything on its head. Let's say you own a put option with a $130 strike price and the stock price hovers at $120. Voila! Your put is in the money by $10. This $10 slice is the value your option holds independently. It's like the diamond in the rough waiting to shine. Now, let's dive into its counterpart, extrinsic value. Extrinsic value is like the mysterious sidekick in the world of options. For out-of-the-money options, guess what? Their value is almost entirely extrinsic. Now, as the clock ticks toward expiration, extrinsic value starts to fade away like a fleeting shadow. And guess what happens if the option remains out of the money at expiration? You got it! Both their intrinsic and extrinsic values drop to zero. As time passes and expiration looms, extrinsic value diminishes. When the option remains out of the money at the finish line, both intrinsic and extrinsic values hit rock bottom. Zero. That's why those options seem to vanish into thin air. Don't underestimate the power of extrinsic value. It's the dynamic force that shapes the fate of your options as time progresses. By now, you've conquered the art of buying calls and puts, but here's a truth that might rattle your trading universe. Most traders stop right here, and perhaps that's why so many find themselves losing money. To truly thrive in this domain, you need to be a master of both sides of the options coin, buying and selling. Trust me, this is the game changer that separates the average traders from the successful ones. Picture this: more traders walk the path of profit by selling options than buying them. Yes, you heard that right. Selling options is where untapped potential lies. It's like the gold mine that too few dare to explore. But here's the twist. We're not just talking about naked selling. We're diving into the basics of short selling options. Even if the idea of naked selling sounds intimidating, hang tight. Understanding the workings of selling options is your ticket to mastering advanced strategies like iron condors and vertical spreads. Think of it as expanding your language skills. You've got the basics down with buying options, now let's extend that vocabulary to include selling options. In the stock market, your moves are simple. Buy or sell shares of stock. If you buy, you profit when the stock climbs. If you sell, you profit when the stock's value falls. Let's focus on selling for a moment. Shorting stock involves selling a stock you don't own with the expectation of buying it back later for a profit. Imagine selling a stock for $100 and buying it back at $90. That's a $10 profit per share. It's like buying a sweater on sale and then selling it at its original price. Alright, let's take this concept and apply it to options. Yes, you heard right. You can also sell options. And guess what? Options traders absolutely love it. They call it selling premium. Just as with selling stocks, the goal is to sell an option high and buy it back low in the future. It's like taking advantage of a sale, but with options. Picture this. You're at the starting line of an options trade. You decide to open a trade by shorting a call option for a $5 premium, which translates to a $500 credit into your trading account. You decide it's time to exit, and you buy back the same call option for $3, costing you $300 out of your account. So let's do the math. You sold the option for $5 and buy it back for $3. That's a net difference of $2 or $200 in premium. Voila, the results are in, and you've just pocketed a cool $200 in premium. Imagine a profit made just by leveraging your understanding of options and executing a well-timed trade. But remember, you must have a margin account to sell short options. How much margin do you need to sell a naked call? Now we're about to explore how you can actually generate profits from a short call option stance when the stock price surpasses the strike price of the sold call option. This phenomenon is attributed to what's known as the break-even price. Keep in mind, to calculate the profit or loss of an options position, you should factor in the debit paid or the credit received. Picture this scenario. You've shorted a call option with a strike price of $400 and received a net credit of $17. Now, the million-dollar question is, at what stock price does your option need to be valued at $17 or less upon expiration? With a short call at a strike price of $400 and a juicy credit of $17, any stock price under $417 per share makes your trade profitable. The break-even point for a short call is when the option's intrinsic value matches the credit you received. In our case, it's $17. It's like finding the perfect balance where your trade remains favorable. And you know what? The break-even point is easily calculated. It's just the sum of the strike price and the option premium you sold. As we approach the end of our options journey, it's time to unveil the short put strategy. Remember, all options trading strategies are a blend of long puts or calls and short puts or calls. After mastering the mechanics of short puts, you'll find yourself well prepared to tackle advanced tactics like the diagonal spread with ease. Shorting put options, just like shorting calls, involves selling options you don't own. However, shorting puts might seem counterintuitive at first, so take your time to wrap your head around it. Typically, when you short something, you anticipate its value to drop. But with put options, it's the opposite. You're essentially betting on the market to rise. Wait, bullish strategy with short puts? It might sound contradictory, but here's the magic. While a long put profits from market declines, selling that same put thrives when the market climbs. This unique dynamic is why selling put options is considered a bullish strategy. It's a way to capitalize on market uptrends. Brace yourself, because once you master the art of selling put options, a world of advanced strategies opens up. Just imagine the possibilities with tactics like the diagonal spread. It's all about building upon your knowledge and expanding your trading toolkit for more opportunities. There you have it, trading explorers. Don't forget to hit that subscribe button and ring the notification bell so you won't miss a single moment of our exciting journey. Thanks for joining us on Stock Market Callus, where options trading isn't just a skill, it's a gateway to endless trading possibilities. Don't miss out our videos on Understanding Options, Beginner's Guide, and Options Trading Series Part 1. These videos are the perfect starting point to enhance your investment strategy. See you!